the introduction, Alex. Okay, so as Alex mentioned, we're going to talk now about some issues and opportunities around maximizing R&D in digital media claims. We know that our operations, our activities, things that our employees do on a day-to-day basis dictate and drive whether we can claim R&D and digital media credits or not. Away from that level of detail, to maximize R&D in digital media, there are other issues that are not at that detail level, more at a macro level, at the level of the entity. And I think one of the points I wanted to convey this evening was that in order to identify those kind of opportunities and issues, it's important that your R&D professionals and your tax professionals are working together, working as a team. And it's in that situation where you get those benefits. So first of all, we're going to talk about maintaining high rate eligibility on SHRED. We have a taxable income threshold, $500,000 to $800,000. At $500,000 or less, assuming you're otherwise qualified, taxable income below that level, you're into the high rate and refundable R&D credits. Over $800,000 of taxable income, those high rate R&D credits disappear. Between those 2 points, your credit is gradually ground down. So it's very, very beneficial to keep underneath the $500,000 threshold. There are ways of accomplishing that if your taxable income is over $500,000. One of the most common ones is bonusing down, what we refer to as bonusing down. It's really quite simple. Pay a bonus to key employees, for example. You drive your taxable income down below the threshold and get back into the eligibility for high rate and refundable credits. Aside from something like that, which is a fairly standard plan, the situation itself that your company or entity finds itself in might present a different opportunity to get below that threshold. An example we had recently with a client, a software client had just acquired a new business, had taken over an existing business. And the business they acquired had a couple of years of R&D claims, having filed R&D claims. And in talking with our client, they decided it would be a good idea for us to go in and look at those R&D claims and see if there were any dollars left on the table that we could extract. But as well as that, we asked that we have a look at the tax returns of those years. And it was in looking at the tax returns that we found our opportunity, which was basically their taxable income was above the $800,000 threshold. I think in 2 years back it was maybe $2 million. The previous year it was $1 million. And we noticed on the tax return there were a lot of discretionary tax deductions that had been taken. So we went back 2 years and actually revised the tax return so that they weren't claiming so many discretionary deductions. We actually raised the taxable income of that year. Now they had non-refundable ITCs, which meant there was no cash tax implication. Raising up that taxable income didn't cause them any hardship in that year. In the following year, we then had a bigger pool of deductible expenses for tax purposes. We claimed those and drove the taxable income down below the threshold. And in doing that, the following year, they qualified for the high rate refundable ITCs, and their cash refund of that year was higher than it would have been had we not had the opportunity to look at those tax returns and come up with that plan for them. I'll move on now to taxable capital threshold, which is similar to the taxable income threshold, except that rather than being an income test, it's a capital test, so there's the size of the business. Taxable capital, just briefly, is essentially a look at your balance sheet from a tax perspective, taking your equity, a certain indebtedness, offsetting that against certain assets that qualify as an investment. And you come up with basically a number that, for tax purposes, is the size of your business, the capital of your business. However, a certain threshold, you lose those high rate refundable ITCs. So that kicks in at 10 million. and by 50 million, those refundable credits are completely ground down to nothing. Planning around the capital threshold is a little more difficult because obviously your balance sheet at year end is what it is. After the fact, you can't change it. But if you're aware of your business growing and you think you might be approaching that kind of size, you can look at your balance sheet prior to the year end and see if there's any planning that can be done. So for example, if you had excess cash in the business, it could be deployed in such a way that you can reduce your taxable capital calculation, and you might be able to get yourself under the threshold or reduce your taxable capital to increase the amount of refundable ITCs at the high rate. CCPC status, Alex mentioned CCPCs, Canadian controlled private corporations, so essentially a private corporation that's not controlled by non-residents or non-residents. The implication of CCPC status is if you're not a CCPC, you don't qualify for those high rate refundable credits. So it's important to watch out for a status, and there's two common situations where you can kind of lose track of what your status is. So if you incorporate a business and you've got a few founders, if some of them they operate between, say, the US and Canada, if they're not Canadian residents, if they're actually US residents, you could end up not being a CCPC from day one. So it's important to know that you are a CCPC based on who has voting control of the company. I should mention that Canadian control generally is voting control, so 50% of the votes of the company being held by Canadians. The definition is a little more intricate than that. I don't want to get into it now because it would take a long time, but you think of it as more than 50% of voting control. That's a good starting point. The other situation where CCPC status can become an issue is if you, say 3 years ago, you're fully aware you're a CCPC. In the intervening years, you've had some rounds of financing, for example, you've had some VCs come in and take stake in the company. It's important to know where those VCs are from, because you could find that your shares are owned by non-residents, and in that period of time, through successive financings perhaps, you've lost track of where it is, where your shares are, held by Canadians, held by non-residents. Use of partnership is a similar situation, but watch out for it. The implication is the same as with the CCPC status. If you operate through a partnership, and you're doing R&D through a partnership, you're not eligible for that high rate refundable R&D credit. We had an interesting situation with a client. The client was new to the firm. We sat down with them very early on in the relationship, and they explained the structure they had put into place, which involved a partnership, which was a great idea for them. There were very good business reasons for doing that, flowing losses, startup losses out to the investors. Unfortunately, from an R&D perspective, it meant that they would not be able to get into the high rate refundable credits, which is important for a fledgling business because it's cash coming back in. So they told us about the partnership. And we suggested that rather than continue with the partnership structure by itself, they put a corporation into the group, house the R&D employees in the corporation, and that way qualify for the high rate shred, refundable shred. And they didn't have to eliminate the partnership structure entirely. They could do both. It worked very well for them. Their refunds were a lot higher than they would have been left with just by using a partnership.
Could you use the mic, please? We can't hear you clearly.
Oh, I'm sorry. Is that better?
Yeah.
Maintaining eligibility for digital media. There's a similar situation. Your day-to-day activities, the things your employees are doing, will really drive whether you qualify if you've got a product for digital media. But there's also that entity-level consideration. A good example with digital media is the 90% test. To qualify, 90% of your digital media costs need to be incurred by the claimant, the one entity. And if that's not the case, then you don't qualify. So you can imagine a situation where you have a parent company with 2 subsidiaries. One subsidiary undertakes 40% of the work on the product. The other takes the other portion, or neither qualifies. It doesn't make a whole lot of sense, but that's the rule. So it's important to bear in mind that you need to keep 90% of your costs within the one entity in order to qualify. The easiest thing to do, obviously, is just to house your digital media in one entity. But you do still have to watch out for example, contractors. If a contractor is undertaking 20% of your work, then you won't qualify. I'll figure out how this works. So just some brief notes about maximizing, and I don't want to get into the same level of detail with these, but they're probably worthwhile mentioning because it is stuff that comes across, that you come across quite often. The salary versus bonus question. If you pay a salary, the entire amount qualifies for your high rate ITCs. If you pay a bonus, it does qualify, except not for the part that Alex was talking about earlier, the proxy amount, which is that gross up that's meant to compensate for overhead type items. So if you're looking at employee compensation, and you're trying to factor which one suits your business best, it's important to bear in mind that a dollar of salary is going to get you more back in terms of your R&D claim than a dollar of bonus would. Stock comp is a great compensation tool. Unfortunately, it doesn't work well for R&D. And it ties into the previous point. If you're looking at your overall compensation for employees, it's worth factoring into your considerations that paying with stock comp doesn't get you anything back for R&D and digital media. You can weigh into that computation of how to compensate employees. IRAP funding and other government funding can reduce your claim for ITC and digital media. If you have an R&D product you're working on, if you've also received an IRAP grant in respect to that product, a little of the IRAP grant will reduce your expenditures for R&D. One way around that we have seen in the past is to try and tag the grant to an activity or product that you're not claiming R&D on. And in that way you can keep the two things separate and maximize the R&D credits that would otherwise have been ground down by the IRAP grant or whatever other government funding you might receive. Lastly, another example that we had quite recently with an M&A deal close. One of our clients was taken over. As part of the deal, certain employees were paid a bonus. And so the question was, well, the bonus, what is it in respect of? It was in respect of their employment duties. And these were people who were performing R&D. So we were able to include those bonus payments in the R&D claim. And increase the amount of cash coming back to the company. So it's worth considering, the employees receiving payments, even though they're labeled as bonuses and you might not qualify for that proxy gross up, they might be eligible for the shred claim on the whole. So just to recap a couple of messages. Lines of communication are key. If we hadn't been talking to our clients at those points in time, we wouldn't have seen these opportunities and issues. And it also avoids surprises on filing date. You don't want to get right up to the deadline for filing an R&D or a digital media claim and find that there's something that you could have done something about had you known about it sooner. So an open line of communication is very important. And then my first point about tax professionals working as a team with R&D. In isolation, we're not able to see all the opportunities and issues that we see when we're a team. So whoever your tax professional, R&D professional is, if there's an opportunity for them to work together, it can really be of benefit and tangible benefits in terms of cash coming back in to your company. So that was all. I think at this point in time, we'll take some questions. Alex, if
Alex.
you want to join me, and we'll take questions on the two subjects we've been talking about.
So there are 2 microphones out there.
So my question is to Alex. You mentioned that we can get tax credit between 39 to 75 cents on the dollar. So after you take out KPMG fees and other costs for getting those tax credit, how much would you say is the return or tax credit for a small business?
Good question. Of course, we have to get paid for what we do. It all depends on what the fees that are being charged. They could be, excuse me, on a contingent basis, they could be on a fixed fee basis. So it's really hard for you to answer the question, but yes, there will be some cost associated with that. It all depends on the size and complexity of the claim, how big it is. Usually if the claim is much bigger, then our fees would be proportionately less, simply because we get economies of scale and scope. So the simple answer is it depends.
Okay, but I want a specific answer here. So let's take for an example, if you're able to get 75 cents on the dollar, then how much, what percentage? Give me a figure. I mean, you don't have to be specific. You can maybe give a range, like between this percentage.
Sure. So if excuse me, so if we are working for you on a contingency basis, then we would have agreed on the percentage amount up front. And the percentage amount can vary anywhere between 12% to 18%, 20%, it could even be 22%, depending on the complexity of the claim and so on. So there's a big range there of numbers to choose from.
So it will go around 22% maximum.
That's the extreme case. Very likely, like I said, that's the extreme case. I've given you the range. It all depends on how you're able to negotiate something, what's your claim history, how big it is, are you a first-time filer, and let me add to that, the way contingency works is, we basically assume all the risk. So in the end, if for some strange reason, the CRA denies your claim, not that it has ever happened to us, but if, in the extreme case, if it denies your claim, in other words, you get zero, the client does not owe us a nickel. We are taking all the risk, okay? On that same line, if the claim is accepted as filed, then that's great. But a lot of times, that's not the case. What happens is the CRA wants to review the claim. It could be because you're a first-time filer. It could be because the area of sensor technology is somewhat unique, or it could be the RTA. You just happen to get that RTA who's difficult or different, and so on and so forth. So when that happens, there's this secondary process that kicks in, and that is CRA audit or review, as we call it. And if you are working with contingency, then we assume that risk, i.e. we will work with the client in getting them through that phase. Okay?
Thanks very much.
Sure.
So the question I had was, I guess like a lot of the R&D that we did was paid out just from personally and not through the registered company. So my question is, can you claim that amount, and how far back can you go for like shredded?
So one of those little known facts about the SHRED program is that not only can a company claim, you can actually claim that as an individual as well. However, the problem with you claiming the work, SHRED work as an individual is because you're paying yourself, you really don't have any salary costs. So if you undertake research, let's say on your own, you undertake research and you incur some costs where you have consumed some materials or bought some equipment, etc., those would be eligible costs. But you can't pay yourself money without being under a corporate shell. So you can't just pay yourself money and say, I paid myself $100,000, now I get $65,000 proxy on it, etc., etc.
Like, what if it's been contracted work that you've contracted out?
Santino, you want to take that?
I think you'd have a cost then.
Yeah, so there would be cost, and as long as you have the invoices, as long as the work that was performed by the contractor is eligible, because if they're doing some routine work for you, it doesn't count, right? So remember I said about uncertainty and all that? So if the contractor is doing work for you that qualifies, i.e. it meets that 3-part test, then that should be an eligible cost. Of course, you don't get 65% proxy on contractor costs, so it will be just the dollar amount that you pay this contractor. And I'm sorry, the second part of the question was, how far can you go back? It's done on an annual basis. It's part of the tax return. So as a corporation, you have 18 months after your year end to file for that year. For individuals, is it?
I think it's the same. I should preface that I've seen one personal tax filing in about 10 years.
Yeah.
Nobody does it through person. It is possible, but I'd have to actually check because it's almost never done.
I have never seen any at all in the...
I believe the rate's a lot lower too. I think it's like 20% or something.
That's right.
It's really low, so that's why almost no one ever does it.
Yeah. Yeah. So the rate is low, and hardly anybody ever does that, but it is doable.
It's possible.
It's possible.
Thank you.
My question is about the allowance for about $100,000 towards distribution and marketing. The question is, do you have to spend that money here in Canada, or can you take the product for the marketing activities, say, for example, to attend an industry trade show out in the States or somewhere out in Europe?
Yeah. There's no restriction on that. You have to spend it. But if you have to go to Europe or Japan or Las Vegas for the the Consumer Electronics Show to promote your product, then so be it. That cost will be eligible.
Any more questions?
Can you have more than one tax credit applied to the same work? So in other words, like if it is both Ontario as well as federal, can you get tax credit from both these programs?
Okay, so very good question. So let me clarify that. What's not allowed is double dipping. What that means is that you cannot take $1 of expenditure and claim it against, let's say, SHRED and digital media tax credits, for example. So you can't do that. However, you can, so for example, take a gaming company, and this is an example from one of my clients. They're a gaming company, they're developing some really amazing games, but in doing so, they're actually advancing the underlying technology, the physics of the gaming engine and so on. So this client was able to actually claim part of the costs under the SHRED program because it met the criteria, and then the other costs were under the digital media tax credits because they did produce an interactive digital media product that met the requirements of the YDMTC program. So yes, you can claim more than one, but you can't claim the same cost twice. So no doubling.